Hello, and welcome. Today we're diving into a topic that, let's be honest, many of us would rather avoid, but it's absolutely crucial. This discussion is brought to you by the expert at My Tax Accountant, and we're talking about inheritance tax, and, more importantly, how you can actually protect your family's future from it. Right, let's get straight into it.
So, let me ask you something right off the bat. After all your hard work, everything you've built, could your family, your loved ones, be staring down the barrel of a six-figure tax bill? It's a horrible thought, isn't it? But with property prices the way they are, it's becoming a stark reality for more and more families across the UK. The stakes are really, really high.
And this is the number that keeps people up at night, 40%. It's a huge figure, and it can take an enormous slice out of the very assets you wanted to pass on. It's a flat rate, which means once your estate crosses a certain line, this is the number that HMRC is looking at.
Just to be perfectly clear, that 40% is the standard rate of inheritance tax, or IHT, on the value of an estate above the tax-free allowance. It's a pretty blunt tool, and that is exactly why understanding the rules and getting a plan in place is so incredibly important.
So, here's what we've got on the cards. First, we'll cover the absolute basics of IHT. Then, we're going to take a peek behind the curtain at the so-called billionaire loopholes. After that, we'll get practical with a toolkit that's available to everyone. Then, and this is crucial, we'll look at the new budget changes that have really shaken things up. And finally, we'll talk about your next steps.
All right, first things first. Let's get a handle on the fundamentals. This is the bedrock for everything else we're going to talk about, so it's really important we're all on the same page. So, what even is it? Well, inheritance tax is a tax on the estate of someone who's passed away. And when we say estate, we literally mean everything. Their home, their savings, investments, cars, even their personal belongings. It's a tax on the grand total of what they leave behind. So how does the tax-free part work? Well, every single person gets what's called a nil-rate band of £325,000. On top of that, if you're passing your main home to your children or grandchildren, you get an extra residence nil-rate band of £175,000. That brings the total for one person up to £500,000. But here's the kicker. Married couples and civil partners can combine these, potentially passing on up to £1 million completely tax-free.
Now you might be sitting there thinking, £1 million? That's a massive safety net. I'm fine. But that's not all. Here's where most people get caught out. With house prices going through the roof, especially in London and the southeast, loads of families now find that their house alone pushes their estate over that limit. This isn't a tax for the aristocracy anymore. It's fast becoming a middle-class problem.
Okay, so if this is hitting ordinary families harder than ever, you've got to wonder, how do the super rich handle it? That brings us to our next section, the billionaire loopholes. This is all about how the wealthiest families navigate this very same system.
This quote from Tax Justice UK is just wow. In just 1 year, 275 of the UK's richest families managed to pass on their assets while paying little or sometimes no inheritance tax at all. It really opens your eyes to a whole other level of estate planning. So how much money are we talking about here?
The total value that those 275 families passed on was £2 billion. I mean, it's an almost unimaginable amount of wealth just moving from one generation to the next, largely untouched by the taxman. And the tax saving on that, well,
the estimated tax legally saved by these families was around £700 million. Let me be really clear here. We're not talking about illegal tax evasion. This is all about using established, government-approved tax reliefs, just in a very, very strategic way.
So, how on earth is this possible? Well, it's mostly down to two key things: business property relief, or BPR, and agricultural property relief, APR. Now, these reliefs were actually created for a pretty good reason: to stop family businesses or farms from having to be sold off just to pay a tax bill. The thing is, what's happening now is that some of the wealthiest families are strategically buying assets, like farmland, specifically to make use of these incredibly generous reliefs. Okay, so that's what's happening at the top end. But what about the rest of us? Now let's look at the next step, which is your IHT planning toolkit. These are the legal strategies and reliefs that are available to you right now. The first, and maybe the most straightforward tool you have, is gifting. The logic is dead simple. If you give away assets while you're still alive, they're not part of your estate when you pass away. And if they're not in your estate, they can't be taxed. But, as always, there are a few rules you need to know about. So, there are some exemptions you can use every single year without any fuss. You've got an annual exemption of £3,000. And here's a brilliant pro tip. If you didn't use last year's allowance, you can carry it forward and give £6,000 in one go. You can also make as many small gifts of up to £250 per person as you like. And there are some pretty generous allowances for wedding gifts too. If you do this consistently, it can really chip away at your final IHT bill.
Let's put this into a real-world context. Imagine a small business owner in London, maybe a freelance consultant or someone running a local shop. They want to help their kids save up for a deposit on a flat. Every single year, they can pop £3,000 into their child's savings. That transfer is immediately 100% exempt from inheritance tax. It's simple, it's powerful, and it's totally above board.
Next up, let's talk about those reliefs we mentioned earlier, BPR and APR. And remember, these are not just for billionaires. If you own a family business, a stake in a partnership, or a farm, these reliefs were literally made for you. They can give you up to 100% tax relief, which could mean passing on the entire value of your business tax-free.
But you've got to be aware of the rules. The reliefs are for trading businesses, a shop, a factory, a service company, not for businesses that mainly just hold investments, like property rentals. And you have to have owned the assets for a minimum amount of time before you passed away. Now, stay with me here, because that minimum period is something we really need to talk about, as it has just changed in a really big way.
Okay, strategy number 3, using trusts. A trust is basically a legal wrapper you can put around your assets. You appoint people you trust, called trustees, to manage them for your beneficiaries. Think of it like putting your assets in a secure box with a very specific set of instructions on the lid. The big win here is that the box is no longer officially part of your personal estate, so what's inside can be shielded from tax, while your instructions make sure your loved ones get the benefit just as you intended.
And finally, a strategy that comes with a fantastic double benefit: charitable donations. Any gift you leave to a registered charity in your will is completely exempt from inheritance tax. But that's not all. If you leave at least 10% of your net estate to charity, the government will actually cut the IHT rate on the rest of your estate from 40% down to 36%. It's a really powerful incentive for anyone looking to do some good with their legacy.
Right, so we've gone through the traditional toolkit. But this is where things get really, really urgent. The recent autumn budget dropped some bombs, and a lot of the old rules that people have been relying on for years, well, they just don't apply anymore. Let's start with gifting. For decades, we've all known about the 7-year rule. Make a big gift, live for 7 years, and it becomes fully tax-free. Well, that's changed. The tax-free period has now been chopped down to just 5 years. This means the timing of any big gifts you're thinking of making is now more critical than ever.
Now, this next one is a massive deal, and it's going to affect millions of us. For a long, long time, pensions were a brilliant estate planning tool because they sat outside of your estate, meaning they could be passed on tax-free. That loophole is now officially closed. Under the new rules, your pension funds are now included in the value of your estate, and yup, they're subject to inheritance tax.
And remember what I said about the ownership period for business and agricultural reliefs? Well, the goalposts haven't just moved, they've been shifted to a different pitch. It used to be you only had to own the qualifying assets for 2 years. That's now been extended all the way out to 5 years, which makes it much harder to use these reliefs as a sort of last-minute planning strategy.
Okay, so the rules of the game have been completely rewritten. That can feel a bit scary, but it just means we need a new game plan. So let's get into Section 5, Navigating the New Rules. This is your action plan for the new tax year and for the years to come.
The first and honestly the most important point is this. All these changes make trying to do this yourself, DIY estate planning, much, much riskier than it used to be. The whole landscape is more complicated, and getting one of these new rules wrong could lead to a challenge from HMRC, big penalties, and your family getting hit with a tax bill that's way bigger than you ever wanted.
So, what's the new action plan? Step 1. Plan any gifts you want to make as early as possible. That new 5-year clock starts ticking the second you make the gift. Step 2. You absolutely have to review your pension strategy. It's just not the tax-free inheritance vehicle it once was. 3. Trusts become even more important for controlling your assets. 4. Think about life insurance. A policy written in trust can pay out a tax-free lump sum specifically to cover the IHT bill. And finally, the most crucial step of all. Get professional advice to weave all this together into a plan that actually works.
And that brings us to our final section, your next step. This is where we turn all this information into real, meaningful action that'll help secure your family's financial future.
So, I'll leave you with this one last thought. After hearing about all these huge changes to gifting, to pensions, to business reliefs, is your current estate plan, if you even have one, truly ready for this new tax world? For a lot of people, if they're being honest, the answer is probably no.
Look, the rules have changed, but planning and getting ahead of it can still make a massive difference. For expert, professional help navigating inheritance tax and all your other accounting needs, please don't hesitate to contact the team at My Tax Accountant. You can get them on WhatsApp or by phone at 07854-255-375, or just drop an email to info@mytaxaccountant.co.uk. And for more clear, practical tax guidance just like this, please do make sure you subscribe to the YouTube channel. Thanks so much for joining me.